Let's return to the investment front now and bring in fund manager Roger Montgomery, who joins me in the studio. Roger, welcome.
Thank you, Tiggy.
Well, just picking up on Marcus Padley's comments in that interview there, let me ask the guru of value investing about what he said, because he was talking about broker valuations being really way over the mark and share prices being just as likely to lead changes in value as value is to lead changes in share prices.
That's entirely possible when the estimates inside the valuation are too optimistic. So Marcus is right on that front. But let me say this, we at Montgomery Investment Management, we are value investors, and despite the fact the market's been going down 9.6% a year for the last 5 years, in the last 2 years we've produced positive returns by using this particular approach. I think Marcus is right.
Yeah, go on.
I think Marcus is right about broker valuations. They use I don't want to get too technical, but they use a two-stage model and they double count the cash flows. And I won't explain why now, but the result is much higher valuations than what I would produce using an approach that's based on a business. You can invest two different ways. You can treat stocks as bits of paper that go up and down on a screen and try and pick the ones that go up. And that's a lot like betting on black or red at a roulette table. Or you can treat stocks as pieces of businesses and you can try and find the good businesses and buy them at a discount to their long-term values. Now, I agree with Marcus that I think broker valuations are currently too high, and we'll see estimates come down again because global growth has just been downgraded by the IMF. We've seen Japan machinery orders drop 14.8%. They're China's biggest customer, and we're seeing China slow down as well. We've got massive unemployment in Europe.
But
I think
these
we'll
are
see
sort of the
downgraded.
extraneous factors that are influencing valuations. Now, I don't know the details of your value assumptions, but I certainly think Marcus would argue that, if I put it, that you are investing in long term, and that he might say that well, HMS Buy and Hold actually went down in 1997. So
look, yes, there are a lot of people in Australia who use the Warren Buffett type approach for investing and buy forever. We don't. We talk about the approach. We like to buy things forever, but the reality is, with 22 million people in Australia, our companies get to a certain size. They mature in Australia very, very quickly relative to companies in Europe and the United States, and we simply have to sell them. The other thing is that investors become very enthusiastic about stocks, push them well above their values, and that's another reason for us to sell.
I clearly have to get you two together at some point, because I think there's going to be some disagreement.
We'd have great fun.
Let me move on to today, because an interesting PricewaterhouseCoopers report came out on foreign banks in China,
yes,
which I know you've had a quick look at. It's quite positive. Profitability doubled in last year, and most of the banks are looking at a 20% annual revenue growth projected in the next 3 years. That's notwithstanding China's sort of relaxing of it. Yeah.
Look, let me say this. Even on the most stormy day I can ever recall in Sydney, there was a pause in the rain. And that's what we're looking at here. The reality of China is bearish and definitely negative, particularly for Australian investors. And I'm very, very worried that if we look at Chinese banks, for example, they've been lending money to companies. When you look at them in detail on a micro level, their balance sheets are atrocious. Their accounts receivable have blown out in the last 6 months, much more than they did even in the last 12 months. And when you look at them in detail, what you find is that the quality of their cash flows are deteriorating, the quality of their balance sheets are deteriorating, and the banks are lending money to these companies. So on a macro level, we've got problems in China that are going to influence Australia. And on a micro level, looking at individual companies, the picture is even worse. One company, for example, Sany, which Sany Group produces concrete machinery, cranes, road equipment, that sort of thing. They've just let off an enormous amount of staff, and because they've been selling products on generous credit terms, and guess what? They're not able to collect because the customers are going broke.
A lot of the banks are obviously opening branches there, and we're talking about domestic consumption improving.
ANZ would like to expose itself.
But wouldn't that be a positive move?
Well, it would be positive from the perspective that they would be growing their profits on the base that they've already created. So if we're looking for growth, then going to Asia provides growth.
Yep.
But that's in an environment that's slowing down overall, and ultimately for Australia and Australia's market, because the resource sector is such a big part of our market, it's going to be difficult.
Roger Montgomery, thanks again for joining us.
It's a pleasure, Tikki.